Let's get a check in on the bond markets because as equities fall, we're seeing yields move to the upside. 10-year yield now up just about 4 basis points at 354. 30-year yield up about 5 basis points. We want to bring in Gurpreet Gill, Goldman Sachs asset management macro strategist for global fixed income. Gurpreet, great to see you here. So just first, your initial reaction to what we just got from the Fed.
Hi. Well, first of all, thanks for having me on the show. In terms of the meeting outcome, I would say it's very marginally hawkish in the distribution that we saw around the 2023 median projection. The median was expected to go to 5.1%, and that is what we saw, but we've also seen a higher median projection for 2024 and 2025 as well, so this higher for longer environments. In terms of small tweaks to the statement language, they could have also indicated that there would be further rate hikes, but the language still says ongoing. And so the Fed is making very clear that even though they are stepping down the pace of rate hikes, they are not stepping back from this task of taming inflation.
Is it your expectation we'll get 2 more 25s and a hold?
That is our base case expectation at this point, but we're still in this post-pandemic economy where the data is incredibly volatile. As your last speaker just said, it can be particularly volatile around this holiday period as well. But we still need to see that rebalancing of the labor market to ease wage growth and put services inflation on a sustainable path downwards as well. We're not yet seeing that. So I would say the base case expectation is still for 225 basis points rate hikes after today's 50 basis points, but we have to be very data dependent, just like the central bank.
Gurpreet, what do you think of the bond market reaction so far? The 10-year yield up just about 4 basis points this afternoon. What does this signal just in terms of the action that we could potentially see in the coming weeks?
Well, for bond markets, I would say this could be somewhat of an unwind of the reaction that we saw to inflation moving in the right direction, and therefore expectations for perhaps a slower pace of tightening ahead or a sooner pause. And so I wouldn't read too much into the moves immediately. And I would say big picture, there's 3 important takeaways for the bond market or fixed income investors for the year ahead. The first is that bonds are back, or bring on bonds. The higher yield means that it's the most opportunistic environment for income and total return in more than a decade. But the second thing is really important, and that is that the first statement I just made is far too simplistic for this very complex world that we live in. We're still working through the impacts of the pandemic. The global economy is going to be dealing with the aftershocks of the war in Ukraine, particularly in the energy market, for years to come. And we're heading into 2023 with growth slowing. Earnings is going to start to slow, and so it's going to be much more dispersion. The second key takeaway is be highly selective in this environment. And then the third key point is related to that, and that is right now, quality comes first. And so we have an up in quality bias when we think about the fixed income spread sector. So we like investment grade bonds, we like agency mortgage-backed securities because they tend to be less cyclical as well.
Not sure if you heard our prior guest, Andrew Levin, former Federal Reserve Board special advisor, who said he believes rates will go well north of 6, potentially as high as 7. Your thoughts on that?
Well, I would say, like I mentioned, we're still in this economy where we're trying to work through the impact of the 2 big shocks that we have felt. There are reasons to believe that inflation will settle at higher levels than it has in the past. It's not quite clear yet what that means for the terminal rate and how stable that will be. If we take a sort of step back, coming into 2022, the market expected the Fed's terminal rate to be 1.6% for this cycle. Now it's around 5%. And so a lot can change depending on how the data evolves. And so we'll have to wait to see, does inflation move back down towards 2% and sort of over what time horizon? There is so much uncertainty around the magnitude of those declines and the timing. My best guess would be that inflation is going to start and continue that process of normalization over the coming year, but it's going to be still much above 2% by the end of next year.
Gurpreet, do you think the Fed is going to settle for something higher than 2%? Because I think that's a big question being debated right now on the street, whether or not 3 or potentially even 4% is going to be good enough. Does that work for you?
I would say the Fed undertook a strategy review prior to the pandemic, and it unveiled its flexible average inflation targeting framework. If you were to really take that at face value, they would have to be targeting inflation well below 2% to average 2%, or it just literally wouldn't be possible. I would say in the near term, changing the target before you've even got close to it would damage your credibility. And so I don't expect the central bank to change its target anytime soon. But I do think as we start to settle into a new regime, central banks and academics and others in the markets alike will begin to consider what is the appropriate rate of inflation for this economy that is not just dealing with the aftershocks of the pandemic and war, but you've also had long-term themes fast-tracked. One of those is just this rewiring of globalization. It's no longer just driven by cost and efficiency. Globalization is now driven by supply chain resilience, by sustainability, and by interests of national security. And so all of that does point to a structurally higher inflation regime than we saw previously.
And Mr. Levin made a great point that at some point in the near future, we're going to run up against a presidential election, which changes the equation, certainly for the Federal Reserve, even though they certainly don't want to admit that. So what would you like to hear from Jerome Powell today? Do you expect to hear more about QT and mortgage-backed securities we've heard very little of?
Well, what we would like to hear is more about what the Fed's thinking and what it is taking into consideration. And so what's helpful for us is to know what are the key data points that they are looking at. How is their assessment of the labour market evolving? We saw in recent speeches that Chair Powell has placed focus on the jobs workers gap framework. So looking at how many available jobs there are to workers. And the big hope for the soft landing scenario is that you rebalance the labour market by having new job openings come down, but you don't necessarily have a large rise in layoffs. And so it'd be interesting to see if he alludes to any other data points or, what other data they've interpreted over the past month or so.
Gurpreet Gill, Goldman Sachs Asset Management. Thanks so much. Terrific stuff from you.